Okay, good afternoon. I'm Ashley with Journey Employer Solutions, and we are going to give it just a couple minutes here. I see some last minute stragglers getting logged in here, so I'm going to give it just about 30 seconds to a minute before we begin, but I just wanted to go ahead and welcome everybody to the webinar. Okay, so we'll go ahead and get started. Again, for those of you who did just join, my name is Ashley. I am with Journey Employer Solutions, and thank you so much for attending the webinar today. We really appreciate everybody's attendance and hope you're getting as much out of these as we're aiming to deliver. So today we have Scott Talley with Legacy Financial joining us. He's going to go over some different retirement plans, different options and solutions for you as a business, and then just kind of answer any questions that you guys might have, additional questions that you guys might have. Scott is a great trusted resource of ours. We've been partnered with him for years, almost as long as Journey's been open. So very trusted resource, very trusted partner. And handles a lot of things for our clients. So he'll be a good resource for anybody looking to get some information and or their options to go ahead and add something like this to their plan of benefits. So with that, I'm going to go ahead and get things turned over to Scott. So give us just a second here to change up presentership and we'll get started.
Okay, Ashley, do you see anything live on your end?
Yep, we're good on our end.
Perfect. Well, thank you everybody for joining us today. We'll make this as educational as possible in a brief amount of time that we have. So yeah, Scott Talley, we work here in Fort Collins, Northern Colorado. We specialize in wealth management, and a lot of that work is in the employee benefit arena, helping folks set up retirement plans and other benefits for small and medium-sized businesses. So with that being said, we're just going to jump right in here and talk about the reasons why we have retirement plans and some different options you have as the employer. So obviously we know it's a really tight job market right now. Hiring people is really competitive, and so benefits are oftentimes the thing that differentiates one company over the other. So you got to have some good benefits in place, whether that's health insurance, group life insurance, disability, and retirement as well. So it's good for recruitment, good for retaining those employees once you get them and you train them. And then also teaching your employees about the financial responsibility of saving for their own retirement, and just being also less stress at work if you have money saved up in your own personal accounts. A lot of the financial stress that your employees may face may be alleviated knowing they have a rainy day fund. So with that being said, I think most people agree that having some sort of plan is beneficial. So things to consider when you're setting up a plan is who's the primary driving factor for the plan. Is it the owner that is looking for more deductions because they're getting beat up on taxes, or is it employees looking for some additional options and some additional benefits? So the first question we always ask the owner is who's this plan for? Is it for them because they're a small, closely held company, maybe just the one owner and spouse, and we have different options available for them, or is it a 40 or 50 person company, and these benefits have been asked for by the employees? So that really helps drive the conversation on how to set up a plan and the different plans that are available. So another question is, are you looking to provide an employee match? Or are you just trying to facilitate the setup of the plan and then have all the dollars driven into the plan by the participants. Another thing that is important, especially today, is the difference between pre-tax retirement savings plans and then post-tax or Roth savings plans. So there's certain retirement vehicles that will allow for both, and there's others that just allow the pre-tax side. So that's an important factor we also look at. Right now, historically, we're at the lower end for taxes, and so oftentimes our clients prefer to save right now on the post-tax side, put those dollars away, pay taxes on those dollars today, but their thought is when they pull that money back out in retirement, it'll be 100% tax-free. And so no one has that crystal ball on what taxes will be in the future. So oftentimes we tell our clients to split their money between pre and post-tax so that you have the flexibility in retirement to pull from either side of that tax fence, depending on what tax brackets are at any given point. Another question that often comes up is if you own multiple businesses, do you have to offer the same retirement plan options to all your different companies? So that's a little bit more of a complex question, but the short answer is yes. If you have a controlling factor on multiple businesses, the Department of Labor will look at that as basically one business for the retirement plan purpose. So, and there's reasons around that. They don't want you to discriminate one, business and only offer business benefits to the other group that you may be a sole owner of. So they put some nice safeguards in place to help, the general employees. And then the major consideration that we look at when we look at different plans is, do you have employees or not? If it's a one-person operation or maybe just a spouse is also working the business, then we have different options available for sure. And we're going to go through what that looks like if you have employees and also what it looks like if you don't. So here's all the options we have. This isn't every single option you have. There's some more robust additional plans that are kind of more niche plans, but these are the general plans that most people are familiar with and the arena that we mostly work in. So you got your traditional 401ks, 403bs, which is basically the same thing as a 401k, except it's for nonprofit organizations. Simple IRAs, SEP IRAs, solo 401ks, and that's a unique tool that people are getting more and more familiar with, the benefits of a solo 401k. We'll dive into that in a second. You have defined benefit pension plans, which you probably only affect 1 or 2% of the employers out there, but when they work really well. And then for the folks that don't have any employees, you have just your traditional IRAs or Roth IRA that you can set up individually. And then there's executive bonus arrangements that don't really fall under the retirement planning side. They're not regulated by the Department of Labor, but sometimes there's some nice niche areas that executive bonus arrangements make more sense than doing a full-blown retirement plan. So we'll start off with if you don't have any employees. So what does that look like? So the simplest thing you can do is just have an IRA or a Roth IRA. So those are set up individually. You and your advisor would sit down and figure out which account makes more sense. The traditional IRA, as I'm sure most of you know, but I do want to go through the basics here. The traditional IRA comes out pre-tax, and so you get a tax deduction on that account when you make that contribution in. When it grows tax deferred, which means you're not getting beat up by taxes every year as it grows. But when that money comes out in retirement, it will be 100% taxed at whatever tax bracket you're in as ordinary income. So that's the traditional IRA. The Roth IRA is the exact opposite, where you take that contribution you put in, you're fully taxed on that money that went into the retirement plan on the Roth side. So you don't get any tax break up front on the Roth. But when that account grows, it also grows tax deferred, so you're not paying taxes on the growth. And then when you pull that money out on the Roth side in retirement, it will be 100% tax free. So again, having your money split between those different tax treatments is often a good idea in the long run. But in any given year, depending on what taxes are doing for you personally and also generally in the overall marketplace, we will usually lean one way or the other based on tax brackets. Again, $5,500 is the maximum you can put away into an IRA or a Roth IRA in any given year. That adjusts every year. The IRS bumps that up usually. It hasn't changed in a while, so that's due to go up in the next few years. If you're over the age of 50, you can put an additional $1,000 into that account every year as well. Okay, the next tool is a solo 401k. So this is for the single business owner or single business owner and spouse. So what's nice about the solo is you can start off contributing up to $18,500 of your earned income into the account. And the solo has both sides available. So you can do a traditional solo on the pre-tax side, just like an IRA, or you can do a post-tax Roth contribution on the solo and put away $18,500, which is super nice. And on top of that, you also can put away 25% of your own compensation on top of the $18,500, up to a maximum of $55,000. And so, again, you can contribute both sides of the tax fence, and that's for single owner or single owner and spouse. And there's a little bit of a catch-up provision in there as well. If you're over the age of 50, again, they allow you to put away $24,500. And the next plan we have for folks without employees is the SEP IRA. So that, you don't start with that $18,500 base like you do on the solo. It jumps right into the 25% of compensation. And so usually if we're looking at, the difference between the solo and the SEP, for most people, the solo is going to allow for greater contributions in, just because you start with 18.5 and then you go to the 25% on top of that. Where the SEP, you just start at 0 and then 25% of your compensation up to $55,000, whichever is less. So if you're only making, $25,000, you're not going to be able to put away all $25,000 there. So a couple things to note is on the SEP, you can offer that. You can use that tool if you do have employees. It's just not often done if you have employees, because whatever percent that you contribute into your own account, you have to match that same percent to all of the employees that are eligible as well. So most of the time, if you have 3, 4, 5, 10 employees and you want to contribute yourself to your SEP, it's not financially doable to put that same percent away for every single employee that you have. So more often than not, you won't have a SEP IRA if you have multiple employees that aren't, spouse or related. Okay. So now we're going to jump to what options you have for businesses with employees. And feel free to, I don't know if I have questions on here. If anyone has any questions, you can maybe use the tools on your side and feel free to ask any questions. Otherwise, we'll wait till the end and answer any questions you may have at the end. So once we start looking at employers with employees, we look at 401ks. And so there's 401ks that has $18,500 contribution limit, same as the solo 401k. The nice thing about a 401k is there's no forced match. So you don't have to put your own money on the table to match employees if you don't want to. There is an additional party involved on a 401k, somebody called the third-party administrator. So they're the ones that drive the website. They prepare your 5,500 tax filing forms for the 401k plan. And they're really the user interface that you and your employees will be dealing with, is that third-party administrator. For all of the services that they provide, they charge a fee. And typically to set up a 401k plan across the industry, most everybody charges about a $500 setup fee. And then depending on which third-party administrator you use, you're going to spend probably between $1,500 a year up to $3,000 or $4,000 a year just for the administrative side of that plan. And so we help, business owners figure out which TPA is going to be the right fit for them and their size of the company and how much money is going into the plan, et cetera, and try to match those two up. In addition, a 401k plan is regulated by the Department of Labor. So what they want to see is that you're not setting up a retirement plan for the owners or the highly competent employees benefit only. They want to make sure that all the employees that work at that workforce are able to participate in the plan as long as they meet eligibility requirements. And so they do something called a top-heavy test every year. Is they look at the plan assets and they want to make sure there's not huge discrepancy between how much money the owners and the highly competent individuals are putting into the plan versus the average rank and file employees. So if there's a huge discrepancy between those two groups of employees, then sometimes we'll run into some testing issues, and you'll either be forced to offer an employee match, or you'll be required to take dollars back out of your the owners and the highly comped accounts to make those calculations work. So there are some rules that go into 401ks. To eliminate some of those rules, there's something called a safe harbor plan. And there, the Department of Labor is just basically telling you, hey, if you offer a very profitable match and a competitive match to your employees, then we're going to kind of waive a lot of the rules that we've put on inside these plans. So basically the match is you can either do 100% of the first 3% that your employees would put away, and then 50% of the next 2. So basically if your employees put away 5%, you would be forced to match 4% of their 5. So that's one way. The other way is you can simply just say, I want to do 3% of all my employees' pay, regardless if they participate or not. So your obligation there is either 4% in a match or 3% for basically contribution to all accounts. So there is some cost with the 401k you just have to be aware of. But it's a good tool to use because you have high limits on how much money you can put away. Okay, the next slide here talks about another great tool, which is the Simple IRA. So the nice thing about the Simple is there's no setup fees. There's no annual TPA fees as well. So you're going to save the $500 right off the bat by not having to pay that setup fee, and then you're going to save that $1,500 to $3,000 or $4,000 per year by not having to hire a third-party administrator. So there's some immediate savings there. One of the downsides, though, to the Simple is you also have a forced match where you didn't on the 401k. So remember, on the 401k, you could offer it. If people want it, great. If they don't, you don't have to match anything unless you're a safe harbor. But on the Simple, you have to match. And the match formula is similar to the 401k safe harbor, but everything's reduced by 1%. So you have to match basically 100% of the first 3% or a 2% non-elective contribution to everybody that's eligible, regardless if they're participating or not. So most of the employers we work with that choose Simple IRAs will choose that first option of 100% of the first 3. And their thought process is they don't want to just be giving money to employees. They want employees to have some ownership and some buy-in into the program, and they want to have some skin in the game as well. So a lot of the employers we work with, choose 100% of that first 3%. And then again, if you're having some lean years, you can reduce that match to no less than 1% in 2 out of any 5 years. So if you start off at 3% next year, things are a little tighter, you can reduce that 3% match to a 1% match for the next 2 years, and then you got to jump back up to 3. So the nice thing, though, and it depends on payroll size and the number of employees, is oftentimes the amount of third-party administrator fees that you would be paying in a 401k, that $3,000 or $4,000 per year, oftentimes that might be similar to your 3% match obligation on a Simple IRA. And so we always would lean towards, if you're going to put money somewhere and it's roughly the same amount, we'd rather have you fund those dollars into your employees' retirement accounts than to a third-party administrator's admin fees. So we run those calculations with our clients and try to determine what is the maximum out-of-pocket exposure for them. And then if it's similar between the 401k and the simple, again, we'd rather have you pay those dollars towards your retirement accounts of your employees than the admin side. So keep moving along. Won't spend a whole lot of time here. The defined benefit pension plans, things that were popular back in the days, the 50s, 60s, 70s. A lot of folks had these. These were basically what people would live on. You get your watch and your big pension at the end of a 40-year career, and you go along your day and things are good. Those went away with the introduction of the defined contribution plans, which is the 401k type of plans. But just so you know, these still are popular with small, closely held organizations. So if you have a very lucrative, 1 or 2 person operation, and you're looking to put away a substantial amount of money per year, some of our clients, they look at the 401k limits and they max those out pretty quick, and they still are getting beat up on taxes. And so in the right settings, 1 or 2% of those clients, they benefit greatly by looking at a defined benefit pension plan, because you're able to put away hundreds of thousands of dollars every year on a tax deductible basis, depending on your earning income and your age. So again, there are some out-of-the-box solutions that we work with our clients on. The next one is executive bonus arrangements or carve-out plans. So these things are not regulated by the Department of Labor. So all of your other plans we spoke about, the 401ks, the simple IRAs, the Department of Labor looks at those every year and makes sure you're not discriminating against employees and you're not putting all the money into your accounts but not funding any of the participants' accounts. And just make sure that anyone that's eligible, is going to have the opportunity to participate. On a carve-out plan, you can actually pick and choose who you want to offer certain benefits to, which is nice. And so if you're just starting out, or maybe you have a couple of key folks you really want to provide a benefit to, but you don't want to provide this benefit to everybody, we'll work closely with the business owners and those key executives and build a retirement plan vehicle that is discriminatory, that we can say this person is going to get it because they are so key to the success of our organization, but everyone else is not. So there's certain rules around that, but we build those all the time for folks, and those tend to be really popular with those closely held businesses with maybe 1 or 2 very key people inside that organization. Okay. And this piece here is always where we start when we're having the conversation. Most of the time when we meet with clients, they have retirement plan questions, but oftentimes they kind of jump ahead to the benefit of the retirement plan without making sure all the other base benefits are in place and the bigger picture stuff is taken care of. So this is something that we created here locally. This is just how we like to set up business benefits for our clients that we work with. And it seems like most people start from the bottom, which is that supplemental benefit side, which is what we're talking about today. It's retirement plans, but that's where people like to go first. But we like to do the boring stuff first to make sure it's taken care of, which is like your buy-sell agreement. So if you have a business owner, making sure that the buy-sell arrangement is in place in your operating agreement. If something were to happen to one of the owners, where do those shares go? Did they go to a spouse? Did they go to a child? Is there a forced buyout of those shares by the surviving owner? And how was that agreement funded? Most of the time, the people we meet with, they have that agreement from the attorney and they think they're good. And then what they don't realize is there's no money backing that agreement if something were to happen. And those are so easy to set up and very affordable. And usually we just use life insurance. It's a highly leveraged vehicle. But we like to look at that first because that's going to really protect the business and all the employees in that business first. And we can do it a lot easier than setting up a lot of retirement plans. So we want to make sure that's set up first. We end up usually going into a client's office talking about retirement benefits, and then we often find that there's a lot of other issues that are more important than that haven't been addressed. So, we take a holistic approach to this. We don't just come in and work on that one transactional retirement plan piece. We want to really look at your business benefits as a whole and make sure that the company is leveraging everything you guys have grown so hard to create. So put the protection piece in place first, and then we look at the management piece. So do you have those key employees that you want to provide that niche benefit to? And then after that, we'll look at the other supplemental benefits like retirement plans, group vision, group life insurance, long-term care, 529 plans, for kids' education through the workplace, etc. So this is just a good guide to make sure that if you have some of these benefits, just look at the top and see some of those things that you should have done today or should be doing today. Make sure that you have some of those key ones first. So again, having a great team of advisors, I would say, is invaluable. So you've done a great start by having Journey. They're great at what they do. We work with a lot of their clients, and the happiness levels of those clients working with Journey is amazing. So having a good payroll provider, having a really good CPA and bookkeeper to make sure that you're leveraging every opportunity you have. And there's all sorts of different tax rules that have changed recently, and making sure that your CPA bookkeeper are aware of those rules to best advise you. Again, a good business attorney, financial advisor. We are one part of the team, so we work alongside everybody else on that page, making sure that your business is going in the right direction, and we're there to provide some of those protection pieces and also some of the financing for those rainy day moments when, hey, if you've taken the time out during good years to put some money away, that'll help you get you through the lean years, which do come. Right now in today's economy, I feel like a lot of people have forgotten that the markets do go both ways, and business markets and real estate markets and stock markets. So just making sure that some of the protection is in place, and then having a good health insurance and business insurance advisor as well on your team. So with that being said, I'll open it up to any questions you have. We're available to visit if you have any questions. We work here in Old Town Fort Collins, but we would be glad to visit you at your office, place of work, over coffee, whatever it may be. So I guess I will just open it up to any questions. And if there are no questions, our contact information is there. Feel free to reach out to us by email, phone, leave a message, and we'll be glad to schedule a time to visit.
Awesome. Thank you so much, Scott. Really appreciate your time today and going over the different options and how valuable it is to add that to your package of offerings that you have as a business and or individually. So really appreciate that. Like Scott said, we'll open it up, any questions that anybody might have for us, go ahead and shoot them over in the questions box. If it's something you'd rather just jot down that contact information and reach out to them directly, you're more than welcome to do that, as well, as I know some of those questions can be maybe a little bit more tailored towards your business. So we'll leave Scott's information up there for just a couple minutes here, but if anybody does happen to have any questions, please feel free to shoot them over. Otherwise, thank you again, Scott, for joining us today. Really appreciate it, and I hope everybody has a great rest of their day.